If you've ever tried to trade, you know the feeling. You draw a perfect horizontal support line, expecting a bounce. But instead, the market completely ignores your line, sailing right past it while you are left holding an empty net. It's incredibly frustrating. But the truth is, the market doesn't care about invisible floors. Price is driven by living, breathing momentum. To really understand how price moves, we have to stop looking at flat lines. Instead, think of the market like a mountain climber. A climber never hikes straight to the summit. To keep going, they must periodically step backward, descending briefly into a small valley. Here, they set up base camps, catch their breath, and gather strength for the next big push to a higher peak. When you look at a chart, those little steps backward are the secret to predicting the next leap forward. Once you abandon rigid lines and start tracking where the market sets its base camps, you can anticipate where the momentum is heading. In trading, those small downward dips during an upward climb have a specific name: order flow. It's simply the market taking a necessary rest before continuing its upward trend. But to find the right order flow, we need a map. This diagram shows an upward trend. Notice what happens when the line pushes past its previous highest peak. That exact moment of breakthrough is called a break of structure. To locate the point where the market gathered its energy, find the break of structure and look back at the very last downward valley that occurred immediately before the price surged ahead. We draw a box around that specific dip and nothing else. Drawing boxes around any random downward movement won't work. The earlier dips on this graph are irrelevant because they aren't the direct launchpad for our breakthrough. Precision matters. By isolating only that final downward correction right before a structural break, you pinpoint the exact spot where the market gathered the energy to surge higher. Now, you might be wondering, if you draw your box perfectly around that final dip, why do the prices sometimes fall right through it without bouncing? To answer that, let's look at the sketch of two base camps and return to our mountain climber. This illustrates a concept called mitigation. Imagine our climber left their gear down in a valley during their ascent. If they've already hiked back down, retrieved their gear, and left, that base camp is now empty. In trading, we call that empty valley a mitigated zone. The energy is used up. But look at the second valley. If the climber hasn't returned yet, that base camp is still full of gear. That is an unmitigated zone. It's a fresh, untouched area packed with potential energy, waiting to be activated. Profitable trading depends on ignoring the empty zones the price has already visited and focusing exclusively on these fresh, unmitigated areas where market orders are still waiting to be filled. Let's take everything we've learned on the mountain and apply it to a real financial chart. This animated candlestick chart shows us step 1, verifying that we are in a clear upward trend, making higher peaks and higher valleys. Step 2 is practicing patience. We wait and watch until we see a definitive push past a previous high. Right there. That green upward push gives us our official break of structure. For step 3, we look backward from that exact breakout point. We locate the final sequence of red, downward moving candlesticks before the surge, and we draw our box tightly around them. Finally, we run our most important check. We look at the space to the right of the box to make sure the price hasn't already dipped back down into it. We need to confirm that this zone is fresh, untouched, and unmitigated. By sticking to this strict verification process, a chart that used to look like a confusing mess of red and green lines transforms into a highly readable map. Now that we have our map, how do we actually trade it? First, we let the market slowly work its way back down, retracing its steps until it steps directly inside our unmitigated order flow box. If your box is particularly large, it's smart to draw a line right through the 50. We set a safety net, our stop loss, just below the bottom boundary of the box, and we aim our target at the highest previous peak. Identifying fresh order flow and waiting for a confirmed bounce allows you to align your entry with the actual momentum of the market.